But for example, what I noticed once myself as an economist, that we had invited an investor in one of the macro classes, international finance, that we taught. And he said, like, we use some of your models. So we use the impossible trinity, which is a concept in macroeconomics that you cannot have central bank independence, a fixed exchange rate, and free capital flows. That's a concept. And you can use that model to look at a country. And for example, if you use that model on Sri Lanka, you could have seen like, hey, something's got to give here. They had a fixed exchange rate. They wanted monetary independence, but and they had capital, a free capital. And that can truly break an economy. But what he then told me as well is that most of the students in that economics class, and I'll admit, myself included, for a brief moment of weakness, we're thinking like, hey, oh yeah, what are weak countries, right? And we're not going to invest in that. But that's wrong, right? It's like, hey, what are weak countries that are cheap and we're going to invest in them? Or what are strong countries but are overpriced, right? Or what are weak countries and are expensive and short them? But yeah.
And that's the thing is, to the point about investing in bankrupt companies, you can make a killing in that space. And it's not to say that I don't think it's an invalid approach to investing. And, Warren Buffett his first approach to investing was what he called the cigar butt approach, which was the idea of getting one last puff out of whatever he bought in. And there were times where he would make money even if the company went bankrupt. Because, for example, the assets of the company, so, their factories, their real estate, whatever they had, was actually worth more than what the stock was trading for. So even if the company goes bust, if they liquidate everything and push that money back to the investors, you could still make a return.
Yeah.
So that's something to keep in mind is certainly, what a lot of people have seen over time is that markets tend to, and this is a broad statement, so, there are obviously exceptions, but generally speaking, markets tend to overvalue excellent positions and tend to undervalue distressed positions. So if you can find those positions that are distressed, but have, a potential to, at the bare minimum, even just stay afloat, but are valued even less than that, then you could still make a profit if that normalizes back up to even a distressed level. So that's the thing is even within fundamental analysis, there are totally, a wide array of different approaches to investing. Some people who are a lot more willing to take riskier approaches when it comes to debt restructurings and whatever have you. For us, though, a lot of the time we're managing money for households that aren't looking to make, hundreds of % of return and really are focused on risk. Like you'd be surprised how many millionaires just don't want capital to be depleted. Like they just want their money to grow a little bit without much risk.
Yeah.
Which is actually opposite to what you would expect, because you would think, well, you have, the more money you have, the more risk you're willing to take on. A lot of the time, the clients we deal with, if they're an everyday Joe who either worked up the corporate ladder and got a good position and makes a lot of money, whether they be a business owner, a lot of the times they just want to set their finances and forget it, and they don't want to check their statement and see that they're down 50%, even if it means that they'll be up 100% next year, whatever have you. A lot of people focus on risk, which funny enough can be a detriment. But all to say that it's
and then they come
there's
to you,
opportunity
the riskless plain bagel.
Yeah, I wouldn't say I'm riskless. I would just say that when it comes to things, there are certain types of risks that I'm not willing to take. There are risks that we take. You wouldn't make any money if you didn't take any risk. So there are risks that you have to take. The thing, though, is to balance that risk with your tolerance and to keep in mind the risk of a position relative to every other position you own in your portfolio.
Yeah.
If, for
correlation,
example,
you mean?
Yeah, correlation. Yeah, so if you think of diversification, trying to find positions that are uncorrelated, you don't want everything to fall at the same time because of the same risk factor. So one that we saw over the last few years, a lot of people jumped into tech stocks, high growth companies, and then now that interest rates are rising, all those positions are very highly, the whole market is down.
Yeah.
But the ones that have fallen the most are those high growth tech focused positions. So it's just kind of from a risk perspective, you really shouldn't put all your eggs in one basket, even when it comes to sector diversification. So you can take risk, but
don't be ARK
manage
Invest,
that risk
is what
too.
you're saying.
Yeah, I mean that's an example. I wasn't going to name drop, but yeah.
Yeah, I can as an academic. I can just say stuff that pisses people off more than you.
Yeah, I mean, like I think I can talk out against money managers, but Yeah, ARK Invest is an interesting one because I remember, Tesla is a bad example because they're actually up. If you look over the past few years, yes, they're down currently from their all time high, but they've done well
Mm.
over the last few years. But I remember reading ARK's research report on Tesla, and this was before the recent share split. So right now, pre-share split, they're between $600 and $700. And I remember their bear case for Tesla was $1,300. And I was like, no, that's not what bear case means.
Mm.
Bear case is bad. You can't say our worst case scenario is Tesla doubling.
But my
So
worst case scenario for Bitcoin is $100,000, Richard.
well, hey, that sounds like a great investment thesis. But like that's the thing is,
Yeah.
their approach, I think they didn't hire many financial analysts. I think they were trying to take the approach of, hey, well, and if you bring engineers and if you bring tech specialists and you put them into an investment team, you might outperform the market.
Mm.
And I think the Renaissance Fund is a famous hedge fund that consistently outperformed the markets for a number of years. And I think that was actually their approach: is they hired PhDs and academics as opposed to your Wall Street analysts. And I have a feeling that Tesla might, sorry, not Tesla. I feel that ARK might have been trying to replicate that. Hey, if we hire outside people to think differently, and there's validity to that.
Yeah.
But then I think their models might have been a little flimsy because of that. I think they might have just wanted to have at least one stock guy to be like, hey, this model doesn't make sense.
Yeah, or let them watch the plain bagel to at least get the basics, right?
At least, yeah. I mean, yeah. Maybe it would have helped. I don't know.